This ratio predicted the fall of Rome in the Silver Age. It just triggered again. And a huge impact is on the way, not just for the United States of America, but for the whole world. It is the single most reliable distress signal in financial history, a warning bell that rings loudly right before an empire collapses and a currency dies. Yet, most modern investors are too distracted by the noise of the stock market to hear it. In this video, together, we are going to expose the mechanism behind the signal and show you the exact data point that proves the current system has already entered its terminal phase. To understand the danger you face today, we must first understand the rule that was broken. For over 2,000 years, long before the concept of a gold standard or the complex derivatives of modern banking, there was a natural law of money. We call it the divine ratio. If you dig into the Earth's crust right now, for every 1 ounce of gold you will find roughly 19 ounces of silver. It is a geological constant written into the planet itself. Because of this physical reality, ancient civilizations, from the Greeks to the Romans to the European monarchs, pegged their money accordingly. The exchange rate between gold and silver sat firmly between 12 to 1 and 16 to 1. It was stable. It was honest. But honest money is the enemy of dying empires. When Rome began its slow, agonizing death spiral, they didn't announce it in the Senate. They hid it in the mint. Just like today, the leadership needed to spend money they didn't have on wars they couldn't win and a populace they needed to pacify. They couldn't simply tap a button to create a deficit like modern central banks. They had to physically debase the currency. Look at the silver denarius, the backbone of the Roman economy. Under Emperor Augustus, that coin was 95% pure silver. By the time of Nero, it had slipped to 80%. By the late 3rd century, under Aurelian, that silver coin was merely copper, washed in a thin layer of silver, of 5% purity. The silver had vanished into private hoards, leaving the public with worthless base metal. The ratio between real value and the government's face value had shattered. What followed was the first hyperinflation in Western history. Prices skyrocketed, trade collapsed, and the most powerful empire on earth disintegrated because they broke the link between their money and physical reality. This isn't just ancient history, it is the exact blueprint for the financial engineering we see today. You might be thinking that Rome was an ancient anomaly, a primitive society that simply lost count of its coins. But let us fast forward to the modern era, to the industrial powerhouse of the 19th century. For decades, the United States and much of Europe operated on a bimetallic standard. The ratio held steady at roughly 16 to 1. It was the bedrock of trade, ensuring that a farmer in Ohio could pay his debts just as easily as a banker in London could settle his accounts. But in 1873, that stability was deliberately assassinated in what historians now call the Crime of 73. With the stroke of a pen, the U.S. Congress passed the Coinage Act, effectively demonetizing silver. They ceased the minting of the standard silver dollar, forcing the entire economy onto a strict gold standard. This wasn't a mere administrative update. It was a calculated assault on the working class. You see, the wealthy elites and the banking cartels held their fortunes in gold. The farmers, the laborers, and the debtors held their savings in silver. By destroying the monetary status of silver, the government artificially spiked the value of gold. The ratio, which had been the heartbeat of commerce for centuries, instantly broke loose from its 16-1 anchor. It began a relentless climb, devaluing the savings of millions of Americans overnight. If you owed a debt, that debt became mathematically harder to pay because the money supply had been severed in half. This triggered what we now know as the Long Depression of 1873 to 1896. It was a period of crushing deflation, widespread bankruptcy, and social unrest. The narrative they sold to the public was one of sound money and modernization, but the reality was a massive transfer of assets. Farms were foreclosed upon and consolidated into the hands of the few, all because the ratio was manipulated to favor the creditor over the debtor. This was the first time in modern history that the global system truly broke, proving that when you tamper with the ratio, you don't just change the price of a metal, you alter the destiny of nations. And as the 20th century dawned, this manipulated ratio would return to signal an even greater catastrophe. By the time we arrived at the early 1930s, the warning lights on the global dashboard were not simply flickering, they were burning out. The roaring 20s had ended in a whimpering crash, and as the dust settled, the gold-silver ratio began to scream. In 1931 and 1932, while the public was standing in bread lines, this silent indicator rocketed to a staggering 97 to 1. Just pause and consider the absurdity of that number. It took nearly 100 ounces of silver, a massive pile of physical metal, to purchase a single small coin of gold. This deviation from reality was the ultimate siren. It signaled that the industrial economy was dead. Nobody needed silver for production because factories were silent. Everyone was fleeing into gold for sheer survival, desperate to preserve what little wealth they had left. The ratio was telling us that the global banking system was hemorrhaging trust, and just as the ratio predicted, the system snapped. In 1931, Great Britain, the architect of the modern financial world, was forced to abandon the gold standard entirely. They simply ran out of gold. The pound sterling collapsed, and the contagion spread across the Atlantic like a wildfire. In the United States, the response to this broken ratio was one of the most draconian acts in financial history. Seeing the ratio spike and the banking system implode, President Franklin D. Roosevelt realized the government could not meet its obligations. The promises made on paper could not be backed by the metal in the vaults. So, in 1933, he signed Executive Order 6102. They didn't just reset the system, they criminalized the preservation of wealth. The government seized the gold of private citizens under threat of imprisonment. But here is the detail often missed in history books. To fix the broken deflationary spiral indicated by that 97.1 ratio, the government had to desperately remonetize silver. They passed the Silver Purchase Act of 1934, effectively printing money to buy silver and force the ratio back down. They had to manipulate the market to save the system. The high ratio had correctly predicted the total failure of the classic gold standard. It was a clear message that when the gap between gold and silver becomes a canyon, the government will inevitably change the rules of the game to save itself, usually at the expense of your personal liberty and your asset protection strategies. You might be tempted to dismiss the 1930s as ancient history, a grainy black and white nightmare that could never happen in our sophisticated digital age. But the ratio does not care about technology. It only cares about fear and liquidity. As we moved into the modern era, the signal didn't disappear, it just became more urgent. Let's fast forward to the early 1990s. The world was celebrating the end of the Cold War, distracted by the geopolitical theater of the Soviet Union's collapse. But while the news anchors talked about peace, the charts were screaming about insolvency. In February 1991, the gold-silver ratio spiked again, piercing the psychological ceiling to hit 100 to 1. Just like in the Great Depression, the market was demanding 100 ounces of silver for a single ounce of gold. What was the market seeing that the politicians were ignoring? It was the rot inside the U.S. banking sector, the savings and loan crisis. Over 1,000 banks failed, wiping out the life savings of countless Americans. The ratio was signaling a deep structural recession and a frantic flight to safety that the official economic reports tried to paper over until it was too late. Then, the cycle repeated with terrifying precision in 2008. We all remember the chaos of the global financial crisis, the fall of Lehman Brothers, and the panic that gripped the world. But if you were watching the ratio, you saw the earthquake coming before the buildings started to crumble. In the months leading up to the crash, the ratio was sitting comfortably around 51. Then, as the subprime rot began to spread, it violently snapped upward, hitting roughly 84.1 by October 2008. Why does this happen? It is simple market psychology. When the financial system breaks, credit freezes. Industry grinds to a halt, so nobody buys silver for electronics or solar panels. Simultaneously, fear explodes, and capital flees into the perceived safety of gold. That divergence, gold holding strong while silver collapses, is the heartbeat of a crisis. It is the moment the patient goes into cardiac arrest. In 2008, that spike to 84.1 was the immediate precursor to the Federal Reserve printing trillions of dollars in quantitative easing. The ratio screamed system failure, and the central banks responded with the only tool they have left: unprecedented currency debasement. We thought 2008 was the ceiling, the maximum stress the system could handle. We were wrong. In March 2020, as the world locked down and the global economy was placed into a medically induced coma, the gold-silver ratio did something it had never done in 5,000 years of human history. It didn't just spike, it went vertical. It smashed through the 100 level, bypassed the 1930s records, and touched a terrifying all-time high of roughly 125 to 1. This was the moment the gears of global finance completely seized. At 125 to 1, the market was effectively saying that silver, an essential industrial metal needed for medicine, electronics, and energy, was worthless compared to the safe haven of gold. It was a liquidity black hole. Investors were selling absolutely everything that wasn't bolted down just to get their hands on US dollars to service their debt. The bond market froze. The treasury market stuttered. The global financial heart stopped beating. And how did the powers that be restart the heart? They used the defibrillator of infinite cash. Seeing the ratio hit 125.1, the Federal Reserve panicked. They understood that if they didn't act, the deflationary collapse would make the Great Depression look like a mild recession. So they printed. And they didn't just print a little, they printed a tidal wave. In roughly 18 months, they created approximately 40% of all US dollars in existence. They flooded the system with liquidity to force that ratio back down, to artificially prop up asset prices and create the illusion of solvency. The Fed put was no longer a theory. It was the entire economy. They successfully crushed the ratio back down from that 125 to 1 peak, but at what cost? They solved a liquidity crisis by creating a solvency crisis. Every dollar they printed to fix that ratio spike diluted the purchasing power of the money in your pocket. That spike in 2020 was the death knell of fiscal responsibility, marking the moment we transitioned from a managed economy to a fully manipulated experiment in monetary debasement. The system didn't heal, it was simply put on life support, funded by the inflation you're paying for at the supermarket today. Now, you have to ask yourself a critical question. If this ratio is the ultimate alarm system, why hasn't it been shut off? Or more accurately, why is it being kept artificially high? This brings us to the mechanism of control, the secret engine that keeps the American empire running on fumes. The weaponization of the gold-silver ratio to protect the US dollar. For decades, the United States has enjoyed what Valéry Giscard d'Estaing famously called the exorbitant privilege. Because the dollar is the world's reserve currency, America can print money to pay for its wars, its welfare, and its deficits, effectively exporting inflation to the rest of the globe. But this privilege rests on a fragile psychological foundation. The belief that the dollar is as good as gold. If the price of gold and silver were to skyrocket to reflect the true ocean of cash currently in circulation, the illusion would shatter. The dollar would be revealed for what it is, paper promises backed by nothing but debt. To prevent this, the financial establishment utilizes the commodity futures markets, specifically the COMEX in New York and the LBMA in London. This is where the price of silver is actually discovered. But it is a discovery based on fiction. On these exchanges, traders buy and sell paper silver, contracts that claim to represent metal without ever touching a single bar. For every ounce of physical silver that actually exists in the vaults, there are hundreds of paper claims traded against it. It is the ultimate game of musical chairs. By flooding this paper market with supply, they can suppress the price of the physical metal, keeping the gold-silver ratio artificially high. Why do this? Because a high ratio signals a strong dollar. It allows the U.S. economy to purchase real resources, oil, raw materials, manufactured goods, from the rest of the world at a discount. It keeps the cost of living deceptively low for the American consumer, masking the true rate of inflation. It is a form of financial alchemy that turns paper into power. But this manipulation has created a dangerous disconnect between the spot price you see on your screen and the real physical reality. And while the West plays games with paper, the East has started playing for keeps. While Western investors are glued to their monitors, obsessing over the daily fluctuations of the S&P 500 or the latest tech IPO, a silent and massive operation is underway on the other side of the globe. The East has looked at the gold-silver ratio, and they have interpreted it not as a trading signal, but as a clearance sale. They understand something that the average Wall Street analyst has forgotten. Price is what you pay, but value is what you get. With the ratio hovering in the 80s, the Western financial system is effectively telling the world that silver is trash. In China, India, and Russia are happily saying, "Thank you, we'll take it all." This is the greatest wealth transfer in history, happening right under our noses. It is a flow of real assets from the West to the East. Consider China. They are not accumulating paper contracts, they are accumulating physical tonnage. China effectively controls the global solar panel industry, a sector that is mathematically addicted to silver. They know that without this metal, the green energy revolution is a hallucination. By keeping the ratio high and the price low, the US is inadvertently subsidizing the industrial dominance of its greatest geopolitical rival. We are practically paying them to take the strategic resources of the future out of our vaults. Then look at India. For the Indian population, buying silver isn't a speculative gamble. It is a cultural mandate and a primary silver investment strategy. When the ratio spikes and silver becomes cheap relative to gold, Indian imports explode. In recent years, we have seen months where India alone imports a staggering percentage of the entire global mine supply. They are trading their depreciating fiat rupees for the only asset that has survived the rise and fall of every empire in history. The geopolitical implications are terrifying for the US dollar. The BRICS nations are actively building a parallel economy, one that is increasingly detached from the Western financial system. They are stacking the real money at the bottom of Exeter's pyramid, while Western pension funds and retail investors hold the risky paper assets at the top. When the party is over and the paper claims burn up in a liquidity crisis, the wealth will remain with those who hold the physical metal. The West is holding the receipt, the East is holding the goods. And as we are about to see, this disconnect between paper price and physical reality is about to collide with the laws of physics. This is where the math stops being polite and starts being violent. Up until now, we have discussed financial concepts, ratios, currency pegs, and banking regulations. These are man-made constructs. They can be altered, amended, or ignored by a room full of politicians. But you cannot legislate geology, You cannot print an element on the periodic table. And this is where the suppression of the gold-silver ratio collides head-on with the laws of physics. The current system is built on a dangerous paradox. On one hand, Western governments are pushing aggressively for a green revolution and a high-tech future. They want millions of solar panels, fleets of electric vehicles, and massive data centers to power artificial intelligence. On the other hand, they are allowing the paper markets to price silver as if it were an abundant, throwaway commodity. Here is the problem. Silver is the single most conductive metal on Earth. It is not optional. You cannot build a solar panel without it. You cannot build a Tesla without it. You cannot build a Tomahawk missile or an advanced AI chip without it. We are currently witnessing a structural deficit that hasn't been seen in decades. The demand for industrial silver is exploding vertically, yet mine supply is flatlining. The easy silver has already been dug up. Ore grades are falling. It takes 10 years to open a new mine. We are draining the above-ground stockpiles at an alarming rate. Yet, the ratio, hovering near 85-1, tells the market that silver is cheap and plentiful. This price signal is a lie, and it is discouraging miners from finding more metal precisely when we need it most. This creates the setup for the mother of all short squeezes. When industrial giants like Samsung, Apple, or Tesla realize that the physical vaults are running empty, they won't care about the paper price on the COMEX. They won't care about commodity futures or technical charts. They need the metal to keep their factory lines moving. They will bypass the broken paper market and bid for the physical metal directly, at any price. When that panic buying starts, the paper price and the physical price will divorce completely. The ratio will not just correct, it will snap back with the force of a coiled spring releasing decades of tension. The market is currently pricing silver like a relic of the past, but physics guarantees it is the most critical strategic asset of the future. Right now, as you sit there watching this, the dashboard of the global economy is flashing red. We are not looking at a theoretical model or a prediction for the distant future. We are looking at a live data point that is screaming danger. The gold-silver ratio is currently hovering in the mid-80s, deep inside what financial historians call the crash zone. You need to understand the significance of the number 80. Throughout modern history, whenever the ratio has sustained a level above 80, it has been a reliable harbinger of chaos. It was there before 2008. It was there before the pandemic. And it is here now. But there is a specific terrifying anomaly in today's market that makes this situation unlike anything we have seen before. Usually, when the ratio is high, both metals are falling, crushed by deflation. But today, gold is tearing upwards, smashing through all-time highs and signaling a total loss of faith in fiat currency. Yet silver? Silver is lagging behind, seemingly asleep at the wheel. Do not be fooled by this stillness. This is not a sign of weakness. It is the mechanics of a coiling spring. Imagine holding a beach ball underwater. The deeper you push it, the more pressure builds up, and the more violent the eventual release will be. By suppressing the silver price while gold skyrockets, the market is building up a reservoir of potential energy that defies logic. The smart money knows that this divergence cannot last. History dictates that silver must eventually play catch-up, and when it does, it moves with a volatility that destroys short sellers and mints millionaires overnight. We are seeing the perfect storm. You have the inflation hedge demand of gold driving the monetary complex, combined with the desperate industrial shortage we discussed in the previous section. This compression is squeezing the price from both sides. The technical charts are showing a wedge pattern that has been building for decades. We are essentially waiting for the snap. The ratio is telling us that the market is mispricing risk on a colossal scale. It is pricing silver as if the world is stable, deflationary, and peaceful, while gold is pricing the world as if we are on the brink of World War III and hyperinflation. They cannot both be right. One of them is lying. And looking at the debt, the wars, and the printing presses, it certainly isn't gold. The snapback is not a matter of if, but when. And when that spring releases, the ratio will not gently glide back to 30-1. It will crash through the floor. The pendulum of history never stops swinging. It may pause at the extremes, like the 97-1 of the Great Depression or the 125-1 of the pandemic, but the laws of financial gravity dictate that it must eventually return to the center. This is what traders call mean reversion, but in the context of civilizational cycles, it is better described as a reckoning. The divine ratio of roughly 16-1 is not merely a nostalgic relic of the past, it is the geological baseline of the planet. And right now, the magnetic pull back to that baseline is becoming irresistible. Consider what happens to your personal sovereignty when this inevitable correction occurs. We are not talking about a standard market fluctuation where your portfolio gains a modest percentage. We are talking about a repricing of reality. If the ratio simply returns to its historical average of 15 or 16-1, and the gold price remains static, silver would need to appreciate by over 500%. But if gold continues its ascent as the dollar fails, the multiplier effect on silver becomes difficult to comprehend. This is the mechanism of the greatest wealth transfer in human history. It is a shift from those who trust in the empty promises of politicians to those who trust in the weight of physical elements. The window to position yourself on the right side of this transfer is closing. The exorbitant privilege of the United States is running on borrowed time and borrowed money. The East is buying. The industry is consuming. The mines are depleting. The ratio is screaming. The entire system is blinking red, just as it did for Rome, just as it did in 1931, and just as it did in 2008. The only difference this time is the scale of the debt and the speed at which the unraveling will occur. You have seen the data. You have seen the history. The signal has been fired. Now, the final move is yours. History is written by the victors, but it is financed by the prepared. When the dust settles on this decade and the currency reset is complete, will you be one of the few who recognize the signal, or will you be part of the masses left holding paper while the world demands metal? Look at your own portfolio. Look at the debt mounting in the news every single day and ask yourself, do you truly believe the current system can defy gravity forever, or is the crash already baked into the cake? The comment section below is often filled with people debating the timing, but very few debate the outcome. Tell me, are you betting on the unbroken record of 5,000 years of history, or are you betting that this time, somehow, is different?